Hello dear traders. In today's video, we will explore one of the most important and crucial topics in the exciting world of Forex trading. Take profit TP. Whether you're a beginner trader or an experienced one looking to refine your strategies, having a solid understanding of how to set a take profit level can be a game changer for your success. So, subscribe to our channel as we dive into different methods for setting take profit levels, understand their importance, and learn how to maximize our profits while minimizing potential losses. Common methods for setting take profit in Forex. 1. Using support and resistance levels. This method involves identifying key price levels on the chart that have historically acted as reversal points. Traders place their take profit levels just above or below these levels, expecting the price to react accordingly. 2. Fibonacci levels. In this method, Fibonacci retracement tools are used to map out past price waves, and based on the confirmation of dynamic and static resistance levels, traders determine exit points. 3. Risk to reward ratio. This approach compares the expected profit with the potential loss. Professional traders often use a risk to reward ratio of at least 1:2 or higher, meaning the expected profit should be at least twice the potential loss. It must be aligned with your personal trading strategy. 4. Using indicators. Indicators such as moving averages and ATR, average true range, can help in determining take profit levels. 5. Using pivot points. Pivot points are significant support and resistance levels derived from past price calculations. Traders use these levels as take profit targets. 6. Using chart patterns. Patterns like head and shoulders, triangles, and flags help predict price movements and set take profit levels. For instance, traders may place their take profit targets near the price projections given by these patterns. 7. Using price channels. Price channels define a range in which the price usually moves. These can be upward, downward, or horizontal. Traders set their take profit at the upper boundary in buy trades and at the lower boundary in sell trades. 8. Using Bollinger Bands. Bollinger Bands consist of a moving average with upper and lower standard deviation bands. When the price reaches the upper band, it may indicate overbought conditions, signaling traders to take profit. Conversely, reaching the lower band may indicate oversold conditions. 9. Previous swing highs, lows. In uptrends, previous highs can act as resistance, making them ideal take profit points. In downtrends, previous lows serve as support, where traders may exit their trades. 10. Price action. Price action traders rely on candlestick patterns and market structure to make trade decisions. They set take profits based on reversal patterns like pin bars, inside bars, or engulfing candles near key levels. 11. Time-based targets. Some traders set time-based exits instead of price-based ones. They close trades after a specific period, whether or not the price has reached the take profit level. This method is often useful for short-term strategies. 12. Trailing take profit. Instead of a fixed take profit level, traders use a dynamic trailing stop, allowing it to adjust automatically as the price moves favorably. If the price reverses, the trade closes at the last adjusted level, securing maximum profit. This technique is often implemented using indicators like moving averages or ATR. Additional tips. Take profit levels should be set based on trading strategy and market analysis. Avoid placing them too close or too far from the entry price. Regularly adjust take profit levels according to market conditions. Backtest different methods on demo accounts to find the best approach for your strategy. For more professional trading insights and tutorials, subscribe to our channel and drop any questions in the comments section.